Happy Friday, everyone, and welcome back to Open Exchange TV. It is Friday, so we obviously know this means Friday Musings with Jay Pelosky. How are you, Big Blue Jay?
I'm good, Scott. How are you?
I'm fantastic. It's been a great week. It was a wet day yesterday, but it's been a great week. Obviously, volatile markets has obviously kept everyone on their toes, including you. But you've still made time to put together your weekly musings for us. And this week it's titled On to Earnings. And what a fantastic time of the year it is to have earnings. Now, how do you tie all of that into the football side of it? Obviously, you're wearing blue there, so there must be some sort of football game on tomorrow that you might be interested in.
Oh, well, there you go. Look at the astute nature of Mr. Duxbury reveals itself once again. Yes, indeed. There is a Duke, North Carolina football game tomorrow night. So our local neighbors down the road there, 7 miles or so from between separate UNC and Duke. So should be an exciting event. And so, yes, I am representing. Make sure you get the D in there. Make sure you get that Duke blue, not that weak, washed out Carolina blue. Sharp, strong Duke blue. Yes, so that's one part of the football analogy. There's a second part, which the on to earnings comment is really genuflecting towards Bill Belichick's, the New England Patriots head football coach, famous on to Cincinnati quote, which he gave after in 2014. Quick story. 2014, the Patriots had just lost badly to the Kansas City Chiefs, and he was getting all sorts of questions at the press conference, and he just kept saying, we're on to Cincinnati, we're on to Cincinnati, meaning focus forward, right? Can't dwell on what's already happened. And so naturally, the Patriots beat the Cincinnati Bengals the next week, went on to win their fourth Super Bowl in the famous goal line interception game against Seattle. So as somebody who grew up in Massachusetts and who continues to be a Patriots fan, one thinks about on to earnings, on to Cincinnati. And so we are on to earnings, right? It's earnings season, started today with the banks. Before we get too deep into earnings, we have to obviously recognize yesterday's CPI, disappointing number, clearly, for those like us who have been expecting inflation to roll over. But it's also, I think, a pretty good example of what we've been talking about the last several weeks, right? If you go back 2 or 3 weeks ago, we had our monthly. We talked about extrapolation and beyond, warning of the dangers of continuing to extrapolate ever higher inflation, ever more aggressive Fed. And then last week, we talked about two-sided markets and the need to focus on both sides as we approach the end of these existing trends. And lo and behold, yesterday, I don't think you could ask for a more evocative example of a two-sided market than yesterday, right? Open up down 2%, close up over 2%. According to Bespoke, it was only the fifth time in the last 30 years that we've had such an aggressive move in both directions in a single day. So to me, this suggests we are approaching the end of these trends, and markets and investors are trying to figure it all out and trying to understand the differences and where to go and how to position. And so you see this very choppy back and forth action in the markets. And so for us at TPW Advisory, we're focusing forward, we're on to earnings, and we can talk about that here over the course of the rest of our time together today.
Yeah, it was interesting. I don't really watch CNBC that much anymore, just because I can't do it. But yesterday I was, and the CPI number, and
Yeah.
listen, you and I have been around the markets for quite a long time, and we've seen
Speak for
days like
yourself.
that. We've seen days like that
I just
before,
graduated from Duke. What are you talking about? I mean, go
but, but to seeing their reaction on there, they didn't know which way to turn.
Yeah.
It was, and even like speaking to a few clients and so forth, it's like, listen, it's like taking the long-term approach, calm approach to it, which you see people usually panic in markets like this. They don't know what to do. But that was obviously all triggered by the inflation number yesterday. Now, as we come into earnings season, how is this inflation number going to impact earnings?
Yeah, well, I think that's that's part of the big issue. There's a standoff, as we see it, between the inflation ebbing story, which has not yet really happened, and the earnings collapse story, which has not really happened, right? The bears out there are talking about this, big drop off in earnings that has to happen because the Fed is going to have to raise rates more aggressively and too aggressively. That's going to lead to a recession. Recession leads to earnings shortfall. Earnings shortfall takes us down to whatever level you want to talk about. And we talked about that in the two-sided markets, right? We gave the analogy of the stock traders almanac last week, pointing out that the market cycle is set up for a 20% up move between now and year end to offset the drumbeat of, we got to go to 3,000, 2,800, 2,600, et cetera. So I think there's this tension between the two. But what's interesting to us is it's actually starting to surface some talk about pushing back against the need to kill what some people are calling the best jobs market in 50 years, not only in the United States, but throughout kind of the Western world. Think about Europe with record low unemployment, US record low unemployment. And so there's, we quote one of the guys who I think is more astute about this stuff, Martin Sandview, who writes for the FT, talking about, the trade-off between slightly higher inflation and sustaining the best jobs market in 50 years versus driving inflation down to 2% and crushing the best job market in 50 years. And I think that tension, we've talked about it. We're in the camp that the Fed is going to declare victory before it gets to 2%. And we even have The Economist. We link an article in our musings from The Economist, which is talking about a similar situation, the opportunity to have a public-private growth-driven economy across the world to deal with what we've been calling the 3 C's of COVID, climate, and conflict. So while there's a mindset out there that says the Fed is going to drive us into the ground and we're going to have a deep recession, earnings are going to collapse, I actually see, and we see at TPW Advisory, increasingly a pushback against that mindset in a recognition of the need to kind of protect the best jobs market in 50 years and what we need to do to deal with COVID, to deal with climate, to deal with conflict. And I would continue to be of the view that in the near term, high nominal growth environment will support earnings. And then medium term, over the next 3 to 5 years, we think there's a pretty good chance of a much better growth outlook than many think. Most think we're going back to the low growth, low inflation world that dominated 2010 to 2020. We do not. And The Economist and others are starting to push the idea that that's unlikely, and we're going to go back, or we're going to a world of high nominal growth with slightly higher inflation, fueled by public-private investment, capex boom to drive the response to the COVID, climate, and conflict world we live in today. And that's where we sit. So it's interesting, definitely seeing at least an intellectual shift away from the mindset of grinding growth down to 2% inflation versus 3% inflation, sustaining of the best jobs market in 50 years, and dealing with the issues we have to deal with.
Okay, then, as I mentioned there before, I love earnings season. You get to see volatility. There's lots of things to look at, lots of talk about outlook and so forth. What is your earnings outlook then?
Well, yeah, I mean, I guess I laid the prelude, the intellectual case, because I am, again, a Duke grad. Now, if I was a Carolina grad, I would have just gone right to earnings. But since we're talking, I'm a Duke grad, intellectual background, we start with the intellectual backdrop and then get into the specific earnings. So let's do that. FactSet, which we referenced in our musings, is consensus is for about 2.5% earnings growth year over year for Q3 in the United States. FactSet also notes that historically, companies report better than the consensus. In fact, 39 out of the last 40 quarters, so over the last decade, there's only been one quarter, which was the COVID quarter in Q1 of 20, where companies did not beat the consensus number. And that beat is usually about 6%. Now, FactSet goes on to note that over the last couple of quarters, given the rebound from COVID, et cetera, the beat ratio has come down, or percentage has come down to about 4%. So FactSet is basically looking at 6% total at the end of the period, the consensus plus the typical beat. So earnings growth of about 6% year over year in the US for Q3. And the rest of the world, the data is not very dissimilar. European earnings are roughly expected to be about the same. And then in Asia, as you know, we've talked about a desynchronized global economy where growth in Asia is picking up while it's slowing in the US and Europe. We expect pretty decent earnings growth out of Japan, pretty good earnings growth out of Southeast Asia, where we've been gradually adding to some of our emerging market positions, as well as in China. And so for us, we expect to have an earnings season that is supportive of current equity prices, if not higher equity prices from where we are today. Of course, that's tough to do given real yields where they are, given financial conditions, and giving a market that's pricing in, a terminal rate that seems to constantly rise, now somewhere between 4.5% and 5%. But if we have earnings growth of 6 or 7% in the U.S. and in Europe, I don't really see the case for stocks to go down materially. And particularly if you look out a couple of quarters, a lot of people are saying, well, what about 2023, right? We're now in October, going into November, Q4. So what about the out year? In there, markets are expecting about 7% earnings growth year over year for 23 versus 22. And some people are more bearish. If you talk about the Morgan Stanley guys, very bearish. Bank of America, they're talking about 2023 earnings of $200 versus consensus at 240. So that's a big decline. So you really are starting to sharpen that divide between those folks who are deep recession, deep earnings collapse, lower stock prices versus those who are not. The consensus is in the camp of those who are not, given the earnings numbers we just talked about. And we are in that part of it as well. We're more constructive, certainly, than my old firm, Morgan Stanley, in terms of what we expect to see earnings-wise, not only for this quarter, but going out over the next several quarters. And I believe we talked about it last week, but just to reiterate, FactSet over the next 4 quarters, so Q3, 4, 1, and 2 of next year, average earnings expectation growth for the U.S. is about 5%.
Interesting. So taking all of that in, what is the takeaway for the market here for you? Obviously, some people have got the views that this market's still going a lot lower.
Yeah.
Your good old friend Jamie Dimon. Is he Hurricane Diamond or Profit Diamond now? I don't really know which one he is, but he's calling down another 20%. What's Jay Pelosky thinking?
Yeah, well, I mean, if you look at the bank's earnings for Mr. Diamond and JP Morgan, that certainly isn't reflected in anything that they're seeing, right? I mean, the argument against the big drop is that consumers are fine, record low unemployment, tremendous amount of savings built up over COVID, well over $1 trillion, still yet to be spent. And that's in a way a two-edged sword because it suggests the economy has more underlying strength, which does suggest or raises the potential for the risk or for the need for the Fed to continue to tighten, to wrestle that back, because that's one of the things that's really different about this environment. We've never kind of gone into this tightening cycle, slowdown, with $1 trillion+ of excess savings in the consumer's pockets. And that's a big factor. Then you look at corporates. Corporates are flush with cash, right? Absolutely flush. You look at high yield. We've talked about it. I think we discussed it last week. We own high yield in the U.S. It's doing perfectly fine. High yield X interest rate risk is doing great, and that's what we own. And then you look at banks themselves. You look at the JP Morgans. There's no big risk to the banks. They're in fine financial conditions. So that's somewhat of a segue, but I don't really. I think the onus is on the bears to really make the case of there's some risk to significant breakage in the equity market. Granted, when you do have real rates of 1.5%, as we do in the U.S., when you do have financial conditions as tight as they've been since 2008, as we do in the U.S., there is risk of, there's concern for breakage. And that's one of the things that makes us feel that when we do get some signs of inflation rolling over, which I think is a when, not if question, you will see the Fed look to kind of pull back because it understands it's on the edge of what traditionally has led to breakage. The offset again being consumer, corporate, and banks being in perfectly good shape. All right. All that being said, right? Well, I mean, look, it's a complex environment. So if you want the simple thing, go ask the Carolina guy. If you want a more nuanced response, you come to the Duke people.
I'm not getting in the middle of that.
I know. I'm beating it pretty good though, right? hopefully, like the Blue Devils will beat them on the football field tomorrow. The markets. Look, seasonality has finally gotten to the point where it should be very favorable, right? Sentiment and positioning remain extremely offside. You see that in action like yesterday. People flooding to cover their short positions. You have the shift from extrapolating of trends towards kind of a basing indecision effect when you talk to technical analysts. That basing and indecision where stocks are kind of going both, not really making a break lower or a break higher, tends to be a transition period, right? That's what stocks do when they transition from one regime to another. The regime we've had has clearly been a regime of going down. Transitioning, therefore, suggests we're transitioning to one going up. Earnings are cheap. Earnings are good, as we just talked about. Valuation is cheap, particularly non-U.S. equity markets where we're focusing most of our attention. Very, very cheap, and very cheap currencies, completely under-owned. And look, we've been in a bear market. And I'll leave you with two examples of kind of the bear market mentality that we're in, that I think we should be starting to fight. And well, frankly, I've been fighting it for some time, and it's been painful. But look, the headline in the FT about the IMF update to their world economic forecast, right? The headline was "Worst is yet to come." That's a pretty dire headline. Worse is yet to come. We've already been in a kind of a shitstorm, if I can use that phrase on this show.
You did.
Okay, I did, or I didn't, whatever. We've been in a struggle. Worst is yet to come. But the reality, Scott, was that they tweaked their 2023 global forecast from 2.9% global growth to 2.7. That's not the worst is yet to come. Worst is yet to come is like slicing a full percentage point off or something. So then the second point, which really, I think, encapsulates the grind that we've all been in this year. Carson Group data point, they put this out the other day. The S&P has closed up only 43% of the trading days so far this year. That's the lowest percentage of closing up days since 1974. Now, I know you're a young guy. I'm a little older guy, but even I was not really around very much in 1974. So
I was around.
You were like a toddler, but whatever. I was around too, by the way, obviously. But my point is, it has been a grinding, difficult year. We know no one's made money in stocks. No one's made money in bonds. Commodities have been very volatile. So it's natural to be thinking the negative. And as I said, I leave you with our view, which is we're moving from extrapolation and beyond to two-sided markets, which we talked about last week, to onto earnings, which we think are going to be good. And we're getting to a point where inflation is going to show signs of clearly ebbing. And that should be good for the Fed, which I got to think is starting to worry a little bit about the breakage risk of their aggressive actions. And that, in turn, will be very supportive for risk assets, which are, as we just discussed, undervalued, underowned, underpositioned, poor sentiment, good seasonality. Lots of things to think about on the plus side. And then, last but not least, go to hell, Carolina. Go to hell.
Now, before we run off and let you keep on riding on the Duke wagon, we obviously televise this live over OETV and YouTube, and we have our social media platforms on Facebook, Instagram. We've had a question come in during the show. It says, "Hi, Jay. Love the Friday musings every week. You have mentioned that the dollar strength has to subside, but it shows no sign of doing so. And now more asset managers are advising it as a place of safety in these markets. What do you think?
Yeah, that's a great question. We have been talking about that. And our view is quite simple. When the Fed steps back from its really aggressive front-loaded 75 basis point rate hikes, remember, it's only done once. It only had done that once or twice in the preceding decades. It's now done it 3 times in a row, and now looks, after yesterday's print, that it will do it in November as well. So 4 times. I think once the Fed steps back from that aggressive rate tightening cycle, the dollar will roll over. And that's because interest rate differentials, which are really driving this, when you look at the yen weakness, that's because the Bank of Japan isn't raising rates. So the gap between what you can get in yen versus dollars is absolutely tremendous. In the case of the euro, European rates are going up. So that spread of rates between the 2-year bond and the 2-year treasury is actually narrowing. And once the Fed pulls back from 75 basis points, it will narrow further. And that should allow the dollar to weaken. The canary in the coal mine is that typically when the Fed is aggressive, emerging market currencies are the ones that really get whacked. In this cycle, emerging market FX is actually outperforming developed market FX because they have been raising rates alongside, and in some cases ahead of, the Fed. So you look at increasingly, you're hearing central banks in emerging markets say they're done with their tightening cycle. Brazil said that a couple of weeks ago. Chile's central bank said it this week. So there are differences from prior cycles. So our bet is pretty simple. Inflation is ebbing, though it has yet to really show up in the stats. The Fed, once they see it clearly, the data show it clearly, they will step back from their aggressive front-loading 75 basis point hikes. That will allow the dollar to roll over. And the fact that people have been going into the dollar and now recommending it as a safe haven, that's kind of the last gasp. If you look at any chart of foreign ownership of U.S. assets, it's a complete hockey stick. And so I think that when we make the turn, you make the turn in currency, you make the turn in equities, and that is going to set up what I think is going to be a period of sustained outperformance by non-U.S. markets. We're very ripe for that to happen. The U.S. has been the only game in town for well over a decade, since the low in 2009. But preceding that, there were 5 years where the non-U.S. markets outperformed, from 2001 to about 2007. So 6 years. I think we're setting up for something like that.
Well, great to get a viewer's question. I'm glad you looked after that for us, Jay. Listen, have a great weekend. Good luck to Duke. Good luck to North Carolina fans out there as well. I'm not biased.
No. Come on. Oh, God, that's horrible to hear.
Yes. I'm a Buckeye fan. What can I say?
Okay, good enough. All right. Well, yes, go Duke, and we'll see what happens tomorrow night, 8 o'clock. After you watch this video, set your timer for tomorrow night, 8 p.m., Duke, North Carolina, at Wallace Wade Stadium. Go Devils.
Have a great weekend, Jay.
Thanks, buddy. You too.
And for everyone else watching, good luck investing.